Okay, welcome to episode 74 of Talk Your Chart. It is December 2nd, 2025. I have a special guest with me. I am Brett Horowitz. This is not Marco Segura. This is Lane Jones, our Chief Investment Officer at Evensky Katz Foldus. He's got decades of wealth management experience, and he's going to share with us some wisdom. Thank you for joining us,
That's
Lane.
right. Stay tuned.
So let's get started here with a couple of charts. One in particular that came out just last week, and this is a chart showing the S&P 500 every time it's opened up more than 1%, and then subsequently what happened by the time the day was over. The two red dots in the bottom left are times where the S&P opened up 1% and then fell more than 1% by the time the day was over. On November 20th, that happened. The S&P was up 1.9% to start the day. The Dow was up 700, and by the time the day was over, the Dow was down about 1%, S&P down 1.5%. Only happened twice in history, remarkably both times in
This year.
2025.
Yeah.
The first time in April with the tariffs. So, what do you think?
Oh,
What do you think's caused
the
that?
Liberation Day one makes sense, right? You had a midday announcement that sort of stunned markets. That one makes sense. This one is a little, certainly was more counterintuitive, right? The great announcement from earnings from NVIDIA, and all of a sudden, maybe it's a sell the news. You go from this enthusiasm that the AI earnings are real, right? Which is that's kind of what the NVIDIA announcement was sort of saying, but people still wanted to maintain whatever sense of pessimism perhaps was building around AI. And we always sort of, you and I have always joked about how good news is bad news, which is, people like rate cuts and cheap money, and therefore when, get good economic news and maybe the rate cuts aren't coming at the pace they want, maybe, people get disappointed in that. I don't know.
Yeah, they also had the announcement that morning of jobs that was, I think, a couple months old, but it was still over 100,000 new jobs created. So I think, yeah, people looked at that and said, maybe the Fed won't cut rates. But honestly, I mean, I think the Fed is probably going to cut rates. I think is what Wall Street's expecting.
Yeah.
It might be helpful for some people who are looking to buy a house or buy a car or, refinance. It's not going to help most people. Um, but I don't think we do. Does the economy, is that going to be the panacea? Is that going to solve everything? I don't think so, because I think there's a lot more issues out there than interest rates dropping, and that's going to suddenly help the jobs market.
Yeah, I mean, I mean that's probably a pretty broad discussion there, which is that is the economy really doing poorly? This consumer sentiment index would say absolutely. People are pretty pessimistic. But when you look at the GDP numbers, they're certainly not there. And when you look at the jobs numbers, we're at 4.5% unemployment, right? Like, I mean, this is not, double-digit unemployment or anything. So I wonder whether people really have a pulse on how good or bad economic activity is. Maybe they just feel sentiment-wise that things are going a poor direction. Maybe that's a carryover from the tariff expectations that really haven't materialized too much in terms of
Right.
damage to the economy. Um,
Yeah, there's some of that, but there's also, we know it's the K curve. The upper class is doing very, very
yeah.
well. Their homes are valued well. Their 401ks are up. Their brokerage accounts, the lower class is not doing well. The unemployment rate is low, but there's a lot of people who have been on unemployment for a while. The number who continuing claims is very high, so that's part of it. And then we know that the lower class has been really hurt by 3% inflation we've had over the year that hasn't come down at all, and it's been tougher and tougher. And then add to that, debt repayment started for a lot of people that got cut
Yep.
off.
Yeah, I mean, I think that the rate impact of cutting rates certainly has a greater implication in sort of smaller companies, which are more reliant on sort of financing perhaps than the big Googles and Amazons, et cetera, of the world. So maybe that's where some of that enthusiasm is trying to be, hey, we're getting some relief on interest rates. We do know that Scott Bessent and the Treasury are probably going to run hot on inflation. 333 is sort of the program. I don't know that that's going to help, as you said, the sort of lower socioeconomic class that where clearly inflation has landed right on their head.
Yeah, the other thing that could have had something to do with the big sharp move downturn is this next chart showing the circular flow of AI companies. So you've got six different companies here, all that if this was a family tree would be very incestuous in my opinion. They're all buying from each other chips or purchases of infrastructure or getting paid in stock or revenue sharing. And so you have this event where Are all tides going to rise all, whatever the saying is, tides rising all boats? Or is this going to be a situation where one goes down and it takes all the others down with them?
I think you hit it right on the head, which is incestuous is absolutely the exact word that I have used when talking about this, which is, the classic example is OpenAI. NVIDIA takes a $100 billion investment in OpenAI, which is ChatGPT. ChatGPT is owned by one of the hyperscalers to a large extent. They then go buy $300 billion of compute from Oracle, which is then circularly going to go back and have to say, I'm going to have to buy some NVIDIA chips in order to provide this compute. Never mind that OpenAI has maybe like 12, $15 billion in revenue. So how are they going to buy $300 billion of compute, right? Like that's sort of the one that gets people like thinking about the dot-com era. Yeah, I think you're right that the risk here and would make people nervous is that the whole thing is becoming intertwined, and that if the growth expectations, which are significant, under deliver, it will pull a lot of these businesses south. Doesn't mean they'll go broke. They all make, I mean, not they all make money,
Right.
but the big Googles and Microsofts, they print money, right? That's the good part about this, which is who's making these investments. It's these businesses that absolutely print money, which is absolutely
Right.
different than the dot-com days. But I've got some stuff actually that we'll talk about in a little bit that maybe we'll talk about why people are a little concerned about the bubble or a bubble, perhaps.
Yeah, my last comment here. I got a colleague that I've known since I grew up. He's worked for Oracle for a number of years. So we're following the stock pretty closely because they give him stock all the time. I think Oracle was up something like 25% in one day a few months ago when all this news came
Right.
out. And subsequent to that, they've now fallen below where they were since that period because of all the debt and all the money that they're spending to set all this up. So they've got these deals in the future. They've got revenue potentially coming in, but in order to get that, they have to build all this infrastructure first and process it all. And so the worry is you might have revenue in the future if OpenAI can deliver, but in the meantime, you got to spend a lot and take out so much debt, even though you're making billions of dollars.
Yeah, I kind of, I tend to be an optimist, but I think I look at these things as healthy, which is that when you have unbridled enthusiasm, irrational exuberance, right, I get nervous. But people are starting to rightly ask this question of what is the return on investment of this multi-trillion-dollar capital cycle. We know that the multi-trillion-dollar capital cycle is pushing up earnings, we're expected to pick up earnings, but like what's the ultimate profitability that's going to sit on top of that investment, and is it going to dilute what Google and Microsoft and Amazon have been able to do, right? Because these are the people again in the hyperscaler bucket. So I think it's kind of healthy that people are asking that question.
Oh, absolutely, absolutely. Over months and months and months, all we heard was these companies can't do anything wrong, and finally people are looking under the cover to say like, there's something in here that isn't that appealing, and I don't know if I want to be a part of just this meteoric rise we've seen the last few years. But you've got some great charts talking about that. You want to flip over to yours?
Yeah, sure. They're not specifically about AI, but maybe about like
Right.
valuations and how this has looked. That the first chart is just sort of let's look at the actual earnings that have materialized over a period of time. And what you'll see is in the upper right corner, the top line is how have large company stocks grown profits. Ultimately, profits are the weighing machine. That they are everything that drives stock prices, regardless of whether it's sentiment or something idiosyncratic. And what you see on the upper line versus the two other lines is that where has the earnings growth been? It's absolutely been in large company stock, whereas mid-sized companies, smaller companies have kind of flatlined since that post-COVID era, right? So it's not surprising that these are the stocks that are driving returns because they're the ones that are growing earnings. And if we look at the next slide, which is what are valuations saying, and what would I want somebody to take from this, which is if you're looking at the left side of the slide, we see the large cap growth space, which is effectively where this tech com services sort of trade is. And what we can see is in the trailing 10 years, it's up 400%. And the change in the earnings of these companies is up about 175. So over 10 years, forgetting about compounding, they're growing earnings at 17.5% per year, like in simple math, right? But the price has changed 400, right? Normally you would have the price change tethered to the earnings change, right? And so what do we see is that the change in the valuation multiple, which is just a way of saying, is a company expensive? Is it cheap? How much future growth is built into the stock? The multiple expansion has grown 84% over the trailing 10-year period. So it's not just that earnings are growing. It's that the market is now willing to pay a lot more for each dollar of earnings. So the PE now on the large cap growth space is about 38 and a half or so. And if you look at it back 10 years ago, it was in the 20s, early low 20s, right? So not only have the earnings been delivered, but the price people are willing to pay for that future growth has gone up. Now, that's very normal, which is that, like, hey, you can't let somebody just have free earnings growth. Like, everybody knows that they're going to grow earnings at a greater pace. They don't know. They expect in the AI sort of era, right? But what it does say is that a lot of that future earnings growth expectation is already in the price, right? And that becomes a risky thing when expectations are lofty, because if you disappoint, like to your point, maybe all these boats get lowered by a tide. Something changes the AI compute requirement or the number of chips they need or any of these various things that could sort of. It doesn't mean the whole AI busts. I don't like the term bubble because bubble implies that it's sort of a fraud, right? Maybe it just disappoints from the pretty lofty expectations to this chart's point that are already built in there. If I was going to look at the smaller company universe in like foreign stocks, their multiples have barely moved a little bit. Like the small cap space, the valuation multiple is like 18 versus history at like 17. And like the foreign stocks over the trailing 10-year period, the earnings multiple is like 18 versus like a 15, so a little bit expensive. It just goes to show this space has gotten kind of expensive and that the earnings growth that's there, that makes sense. It's just very subject to a disappointment, right? Because it's priced
Well,
in.
we've talked to our clients about how, yes, small cap has underperformed large cap, but small cap has done quite all right the last 10 years. It's just that large cap has done so much better. And I think our clients have always looked at all these charts now showing the weighting of the top 10 stocks and how much are technology and is that what I want to be? And I would say for the last 10 years, yes. And for now, yes, because those are the strongest, most healthy stocks that are growing the fastest, as you've seen here. At some point, though, price will matter. And so the question is, should someone now be concerned with the fact that the top 10 stocks are tech stocks? We don't know how this will all play out because for months and months and months, NVIDIA comes out with these earnings and you say they can't beat this time.
Right.
And they continue to do so. So it could continue on a lot longer before any stock decides to take a hit.
Yeah, if the earnings growth materializes, it's great. I mean, I'm very happy that the biggest stocks we own are large cap technology stocks because they have done dynamite. The fact that we do own a little bit of smaller, but cheaper companies, et cetera, like, hey, I wish I'd owned only the tech sector. But yeah, if they deliver on earnings growth, it will all work out well. And look, they're fantastically run companies, right? Like, there's no disputing that. Low cost of capital, although now they're starting to have to make investments in AI, obviously. So,
And no one's saying these companies are going to go away if there is a bubble, right?
right.
They'll get smaller, but no one's saying NVIDIA tomorrow is going to drop off the face of the earth.
Yeah,
It just
NVIDIA's
might mean that it's not as
they're
big.
sort of the Cisco, which is that Cisco made the routers for the building out of the first version of the internet, right? Like they're sort of priced as if there's this insatiable demand for chips that will never end, and that's probably not true. But as long as you grow earnings at the rate they're growing them, that stock will do fantastic. I'll pivot a hair here, which is that if we are going to talk about why would the market maybe be taking a deep breath, and perhaps it's this AI bubble talk. I don't know that it's specifically AI. We do know that the market absolutely ripped off of the bottoms of the Liberation Day tariffs and has had a really great run, especially in sort of late summer, early fall. What I'd share with you this is how the market normally looks, implications for expected returns, which is busy chart. All I would point you to is the red and the green in the middle there, which is that if you intersect the idea of highly profitable businesses and you intersect it with priced reasonably, right? Like cheap businesses on a relative basis that actually are pretty good in profitability. Those stocks in the green bar, high, tend to earn about 16.5% per year over the last 50 years. And that's versus all large companies at like 12. So there's this premium for if you are inexpensive and producing a lot of profit, right? This is sort of the value factor mixed with profitability, etc. And the converse of that is that if you are very expensive and not very profitable, you should earn a lot less, like you earn 10% versus the market at like 12, right? And this is how the market normally behaves, which is that, hey, like GARP, growth at a reasonable price, all these various things. If we look at the small company universe, year to date, we see the exact opposite, which is that just in calendar year 2025, that expensive companies without high profitability are up 50%, and highly profitable companies that are not expensive are down 10. That is very eerily similar to the dot-com bubble. And I think there's a lot of differences in the dot-com, which is that people are selling sort of high quality stocks to buy on the if come of profitability that are expensive later. That, I think, would be explanatory for why did this market take a deep breath. Because this is what we call a low quality rally. You could argue maybe some of this is that Fed cutting interest rates maybe will help smaller companies that maybe previously they thought were going to struggle more. I don't know. But you see the same thing on the next slide in the mid-cap space, even maybe to a slightly lesser degree, which is that, again, not much profitability and expensive is dramatically outperforming the upper right-hand quartile of good profitability and cheap. That's an unusual thing relative to history, sort of that first slide. And I think that is very, very indicative of a market that got kind of like ahead of itself. And I don't know that I specifically tie it to AI, right? A lot of the AI trade is not in the small or mid-cap space. It's in the large cap space or in private markets. But it is evidence of a market that certainly was trading on a lot of exuberance.
Well, we've said before, you could also call it a healthy pause,
Yeah.
right? At some point, not to beat up on Bitcoin because everyone knows my feelings on Bitcoin, but Bitcoin down 30% in the last few months. Maybe there's a point where people say, the FOMO trade is over. Okay, I'm owning it. What's going on? What's happening? Let me actually evaluate things and not just jump in what everyone else is doing and own all the same stocks. I mean, how many clients now who have individual stocks own the same 7 stocks everybody else owns? And so everyone's jumping on the same bandwagon. So you can make the argument, hey, finally price should matter. And so maybe we're seeing a little bit of here, and maybe we'll see a rotation from large growth to something in the small and value category.
Maybe. Yeah, I love that you say price matters. It's like I should have it tattooed on my shoulder or something because I think it ultimately is really important. Maybe earnings growth is on the other side,
I'll go with you this weekend, Lynn.
No.
You can get it done.
Okay, to be considered. I'm not sure. But yeah, look, a healthy market is always going to be somewhat skeptical. They say a good market climbs a wall of worry. I should go on record as saying that I don't believe that the AI trade is a fad. Something could clearly change it, like a massive reduction in compute needs or a massive reduction in power needs, which is where a lot of these sort of like data center trades are going, etc. And that's something we're actually looking at in our satellite bucket. But I think it's transformative in a big. When I think about back to the dot-com days, right, when we were building out the internet, and I don't think anybody saw coming. I mean, you saw it a little bit, but I don't think anybody saw how absolutely transformative the internet was going to be just to how business was done. That there was these Googles and Amazons that Amazon put Sears out of business, Kodak gone. Apple puts a camera in a phone, right? So I think there's a whole version 2, version 3 of AI, whether it's robotics or self-driving cars or any of this other stuff, that will be not only transformative, it'll be this massive catalyst for economic growth. It'll also be destructive, right? Silicon Valley believes in creative destruction. Like I said, Kodak's and the Sears of the world. But
Okay. Well, thank you for your input today. We're sorry that Marcos is not here, but I think we ended up with a better episode with you being here.
well, let's hope so. We were missing Jim McMahon, or what's his name, Ed McMahon from the Tonight Show, our straight man. So hopefully you and I pull this off.
Okay. Well, thank you for your feedback. Maybe we'll get you in another future episode where you can tell us what's going
to happen. Yeah, I enjoyed it. Anytime.
Thanks, Lane. Have a good
one.
You
too. Take care.